Hi, friends. This is Peter Lemieux speaking to you from the insurance exam queen, Melissa Dillon. I just want to take a couple minutes today to talk about a group of life insurance policies under the topic of flexible premium life, how we can understand them and keep them apart from each other when we're studying. Fundamentally, we have to know three policies, just three. And the first one is called an adjustable life. Now, folks, the adjustable life is the one that's hardly ever asked on the test. And so, I know what it is. I just don't want to go in and explain a lot of nuances about the adjustable life. I will just say this as a summary. The adjustable life policy, picture this if you can. A chameleon. If you don't know anything about chameleons, just Google them. They're very interesting critters. They're a lizard, okay? But the chameleon has this amazing ability to change their skin to their environment. My nephew owned a pet chameleon once. He put it in a aquarium, no water, obviously, just a cage, a glass container. And if he filled that glass container with twigs and branches and sand, that chameleon turned totally brown. And if you weren't looking closely, could actually hide themselves by just being next to the tree. Then he would change the background or the environment of the chameleon to green. He would put in lush greens and green colors and leaves and things like that. And you know, that lizard became totally green, the color of the leaves. So when you would go in there, you would have to look, now, where is he? She, whatever it was, it would change. That's what an adjustable life does. It can change from whole life to term and back again at the command of the insured. I have a whole life and I'm going to go to medical school. I can't afford it anymore. I think I need term. Well, you don't need to drop it and buy a term policy. You change your adjustable life to a term policy, which is going to lower your rates way down, give you your protection. And then when you get out and you're a brain surgeon knocking down $700,000 a year, you say, I want the whole life back. You don't have to drop and buy, you just change the policy. So our adjustable life, very few questions, but it is the chameleon. The second one I want to talk about, because is also doesn't really have a lot of questions on your exam, is called an indexed whole life. This is a little bit more complex to explain and understand. I put it as number 2. It also does not have many questions. On flexible premium life, most of the questions are going to be on policy number 3, the universal life. But the indexed whole life works off of an index. So I'm going to just write 2 on my board. There are many, but I want to write the S&P index and Dow Jones. There's many more, but if you bought an indexed whole life, you would tell the insurance company to increase your cash value like the Dow Jones or the S&P 500. And there are stipulations on that because this is not a variable life. You're not owning any stock here. What the insurance company does, it's best understood in a year-to-year basis. You start off, the Dow Jones is at 1,000. At the end of a year, it's at 1,100. It went up 10%. So the insurance company says, we will increase your cash value up to the increase that Dow Jones experienced. But it's not unlimited. So for example, if you had a crazy year and the stock market went up 40%, your indexed whole life's not going to go up 40. There's what they call a cap. We'll increase it to a certain cap because the insurance company is not buying stock. I'll explain that in a second. What makes it attractive is I can get market-like yields, but I can never lose money. The stock market crashed. What the insurance company does is they keep you at the value you were at the beginning of the year. So you technically can earn 0, but you can't ever lose your money. So you can get market-like yields with no downside. It's very attractive benefit to sell. Now, if you want to know how the insurance companies do this, they never really have you hold stock. They purchase with some of your premiums an option to buy stock a year from now at today's price, which means if it goes up, they exercise the option, buy it and sell it right away. So you never hold it. They buy it at 1,000, sell it at 1,100, make the money. Okay. And if it goes down, they just don't exercise the option. They keep you where you were. Now, you don't need to know any of this for your test. Okay. All you need to know is that in indexed life, you can experience market-like growth based on an index or a mirror of your index that you picked, but you can't ever go down. And I don't want you to try to indulge yourself and try to understand this any deeper. If you get a license and you're going to start selling the product, your insurance company is going to teach you all the nuances of it. For the test, you want to understand index. You choose an index, and the insurance company will mirror up to a certain amount the increases, but you never can lose money. If you just remember those two things, you'll be good on the indexed life. The one that's most commonly sold and the one you will get the most question on is the universal life. Most of you in your text probably have a picture of a bucket. You put money into the bucket, okay? And the insurance company will pay you what we call current interest. Current interest today is not that great, better than it was 12 months ago. But when we first started selling these policies many, many years ago, it was not uncommon to have 10% interest on your life insurance. So they were very popular at that time because you could make decent money. But the insurance company has the right to change your interest. They don't guarantee it. They're going to do what they call current interest. And like any financial institution, they're going to pay you a portion of what they can make. If they can make 12, they might pay you 10. Okay. Any bank or anything like that, that's how they make it. They make their money on the spread. So you got interest that you can earn on your cash value that can go up. It can go down. It never can go below zero. Obviously, there's a minimum of like 1 and 1.5% that you have to get, but you can get, if in inflationary times, these products can get very attractive. How they insure you is they take from your bucket, there's a hole in the bottom of your bucket, and they go in there every month and they take out how much it costs to insure you. 100,000 costs this much, 500,000 will cost 5 times that amount. And so they are invading your bucket. So you don't just have a savings account, you actually have insurance. But two things change in the universal life. The interest rate, as I said, can change by the insurance company, and how much they take out of the bucket will change because as you get older, they take more and more out. So what makes people attracted to it, I believe, is the fact that you can pay whatever premium you want. It's a flexible premium policy. You have a good month, you can put more in. A bad month, you don't make any payments. As long as there's money in the bucket to keep your insurance going, you still have a death benefit, okay? But notice there's no guarantees here because the interest rate can go up or down, because your payments can go up or down. The insurance company guarantees nothing. There's no cash value equals the death benefit at 100. We don't know what your cash value is going to be because we don't know how much you're going to pay and how much interest you're going to get. So the people attracted to the universal life love its flexibility, but they give up something that we had in our old whole life, which was guarantees. Your premiums guaranteed, your cash values guaranteed. So, you know, I'm not saying one is better than another. They aren't. They're just different forms of providing you insurance that you can keep as long as you want, as long as you understand the policy. So in the flexible premium policies, most of your questions are going to come on universal life, very few on adjustable, and maybe a little bit on indexed. One conclusion about the universal life, please understand option A and option B. Now, I don't like to talk a long time on these little introductions, so I might make another video explaining A and B. Option A says that the death benefit you start with is always the death benefit. You buy 100,000, you die 20 years later, it's 100,000. Option B has increasing death benefit. The bigger your cash value gets, the insurance company increases the amount they pay you at death, so it will equal the initial death benefit plus the cash value that you have in the policy. A and B is only available in universal life, not on a whole life, not on the other ones. So in a flexible premium policies, meaning you can change how much you pay into these policies, universal life is the horse. You got to get that clear. And the wagon that gets pulled with smaller questions is your adjustable and your indexed life. Hopefully that kind of turns a few lights on for you and makes these three policies a little more understandable. Look for other explanations we'll be making in the future. Like and subscribe. Check out Melissa's courses that are so reasonably priced. Have a great day.